financial markets were basically engaged in consolidation last week as the boost from the ECB's OMT and the Fed's QE3 announcements faded. Though much volatility was seen in the Japanese yen as the Bank of Japan followed and expanded its stimulus program. Sterling was the relatively strongest currency, as it attempted to break through the 1.63 key resistance level against the dollar but failed. In stocks, the Dow and FTSE traded in tight ranges below the prior week's high, though the DAX managed to break through on Friday. The CRB Commodity Index retreated sharply after from prior week's high of 321.36 to close at 308.98. However, that didn't provide much support to the greenback. After all, some more consolidations would likely be seen this week, but that shouldn't last long. We anticipate Euro's rally to resume, together with risk markets. In the U.S., while many Fed officials spoke last week, one important point was Minneapolis Fed Kocherley-Coulter, a known hawk, changing stance. Kocherley-Coulter said that the Fed should keep the Fed funds rate extraordinarily low until the unemployment rate has fallen below 5.5%, and he urged the Fed to continue the open-ended MBS purchase until employment improved substantially. Boston Fed Rosengreen also quantified that the natural unemployment rate from his position was at the lower end of 5 to 6%. So, an important point to note ahead is whether this 5.5% magic number could be confirmed as a consensus among Fed policymakers. In Europe, Spain easily sold €0.86 billion in 10-year bonds last week, with yield dropping to 5.666%, sharply down from 6.647% in the last auction in August. They also sold €3.9 billion of a new 3-year issue. The average yield on the 2015 bond was 3.845%. Bid-to-cover ratio for the 10-year bonds also rose to 2.8 times, up from 2.4 times back in August. Spanish 10-year yield closed the week at 5.76%, well below the 6% level, but there is still speculation that the country is going to seek a sovereign bailout soon. It's reported that there were discussions among EU officials on a plan to trigger the ECB's OMT bond purchases. Markets are expecting Spain to announce a plan that focuses on structural reports on September 27, which will be a major focus of the week. The Bank of Japan accelerated the pace of monetary easing by doubling the size of asset purchases, in addition to leaving the uncollateralized overnight call rate at around 0 to 0.1%. Slowdown in global economic growth and recent tensions between China and Japan over a territorial dispute are expected to delay Japan's recovery, as exports growth would be affected. According to the central bank, the move is expected to help ensure that Japan's economy resumes a sustainable growth path with price stability. The move came in earlier than market expectations, sending the Japanese yen lower and Nikkei stock index and cash bonds higher. Yen's post-Bank of Japan announcement sell-off was rather brief and staged a broad-based strong rebound. It seemed that, on second thoughts, the markets were not satisfied with the bank's quantitative easing announcement. The bank raised the asset purchases by 10 trillion yen, which is around $127 billion. But that was relatively unaggressive compared to the Fed's open-ended unlimited purchase of mortgage-backed securities of $40 billion per month. Also, the Fed's quantitative easing is seen as unsterilized and should have a larger effect on depreciating the dollar. Also, ECB's OMT was also seen as unlimited in nature, even though that would be sterilized. The September Bank of England minutes unveiled that the MPC members voted unanimously to leave the bank rate unchanged at 0.5% and the asset purchase programme at £375 billion. While policymakers noted that inflation had been coming down more slowly than anticipated, the central bank should not be refrained from expanding the size of asset purchases as the pace of economic recovery remained subdued. We retain the view that the bank would increase the quantity of the programme by another £50 billion as soon as next month. The Reserve Bank of Australia released the minutes for the September meeting. While the central bank left the cash rate unchanged at 3.5%, the minute showed that policymakers are willing to lower interest rates if the economic condition deteriorates further. According to the minutes, the current assessment of the inflation outlook continued to provide scope to adjust policy in response to any significant deterioration in the outlook for growth. Meanwhile, strength in the Aussie dollar has also affected economic growth. As indicated in the minutes, members discussed the possibility that the high level of the exchange rate was weighing more heavily on the economy than might be expected.